What are interest rates? With the continuance of the Ukraine-Russia war, people worldwide are experiencing global inflation. As a result, you're forced to pay much more interest than before. Do you want to know how inflation affects the interest rate? Or what interest rates really are? Hello 101 community, welcome back to our YouTube channel. In this video, we're going to explain to you what interest rates are. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. The cost of borrowing money or the return on savings are both expressed as interest rates. It's calculated as a percent of the borrowed or saved amount. When you obtain a home mortgage, you borrow money from banks. You can use other loans to finance your schooling, purchase an appliance, or get a car. Banks use your deposits as collateral for loans and reimburse you for using your deposits with interest. They fund loans using the money from deposits. Banks offer significantly higher interest rates to borrowers than to depositors. Their profit makes a difference. Interest rates remain small because banks compete with one another for both borrowers and depositors. How do interest rates work? You'll have to pay at least the interest each compounding period, which the bank calculates by using the total amount owed on your loan or credit card balance. If not, even though you're making payments, your total debt will rise. Even though interest rates are extremely competitive, they vary. If a bank believes there's a decreased likelihood that the debt will be repaid, it will impose higher interest rates. Because revolving loans like credit cards are more expensive to administer, banks typically set a higher interest rate for them. Additionally, banks charge riskier customers greater rates. The better your credit score, the lower the interest rate you would be required to pay. Fixed versus variable interest rates. Banks impose variable or fixed rates. The fixed rate applies for the duration of the loan. Your initial payments are primarily interest payments. You gradually pay a larger and larger portion of the debt's principal. Traditional mortgages are typically fixed-rate loans. The prime rate affects variable rates. Your loan payment will increase if the rate does. You need to be aware of the prime rate for these loans, which is dependent on the Fed funds rate. You can typically make an additional payment towards the principal on any form of a loan at any time, enabling you to pay off the debt more quickly. How are interest rates determined? Treasury note yields are used to calculate interest rates. The benchmark for short-term interest rates is the federal funds rate, which is determined by the Federal Reserve. For overnight loans, banks charge one another the Fed funds rate. The demand for U.S. Treasuries offered for sale at auction determines the yields on Treasury notes. Investors fork over more money for the bonds when demand is high. Their yields are thus reduced. Interest rates on long-term bonds, such as 15-year and 30-year mortgages, are impacted by low Treasury yields. How the Federal Reserve affects interest rates. Monitoring the nation's monetary policy, which involves controlling the economy's money, is the Fed's main duty. Despite having several tools at its disposal, the Fed's ability to influence interest rates is by far the most noticeable and effective monetary policy tool. When discussing the Fed raising interest rates, people typically refer to the federal funds rate, also referred to as the federal funds target rate. The Federal Open Market Committee, FOMC, sets a target range for the federal funds rate at its regularly scheduled meetings. The interest rates that the largest commercial banks charge one another for overnight loans are measured against this rate. Banks borrow overnight loans to meet the liquidity standards set by authorities, notably the Fed. The effective federal funds rate is the average of the overnight lending interest rates that banks charge. When something like the prime rate and SOFR change, it can affect other rates. How inflation affects interest rates. When raising the federal funds target rate, the Fed intends to raise the cost of credit across the board. Everyone pays more interest since higher interest rates make loans more expensive for both firms and consumers. Projects requiring finance are postponed by those unable to make the higher installments or do not want to. To receive larger interest payments, it concurrently pushes consumers to save money. The amount of money in circulation decreases as a result, which tends to minimize inflation and moderate economic activity, or cool off the economy. Let's consider how a 1% increase in the federal funds rate may affect the total cost of a house mortgage loan. Consider a family looking for a $300,000 30-year fixed-rate mortgage. The entire lifetime cost of the mortgage would be roughly $485,000. With interest costs accounting for nearly $185,000 of that sum if banks were offering them an interest rate of 3.5%. The average monthly payment would be $1,340. Imagine if the Fed raised rates by 1% before the family was approved for their loan, resulting in a 4.5% interest rate for a $300,000 property. The family would pay more than $547,000 in total over the course of the loan's 30-year term, with interest costs accounting for $247,000 of that sum. They would need to make around $1,520 in monthly mortgage payments. To reduce the size of their monthly payment in reaction to this rise, the family in this example may decide to put off buying a home or choose one that requires a lesser mortgage. The Fed's ability to lower the amount of money in the economy when it hikes rates is demonstrated by this very simple example. The stock and bond markets, credit cards, personal loans, student loans, auto loans, and business loans are all impacted by increased interest rates and mortgages. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buy one of our products. The link is also in the description. Let's continue with the video. Effect of high inflation on interest rates. High inflation is combated by raising interest rates. The cost of borrowing increases when the interest rate increases. This raises the cost of borrowing. As a result, borrowing will decrease, decreasing the money supply or the total amount of money in circulation. If the money supply declines, people will have less money to spend on products and services. As a result, people will purchase fewer goods and services. This will cause the demand for products and services to decline. The price of products and services will decrease as long as supply is stable and demand for goods and services declines. A decrease in the general price level of goods and services will result in lower inflation, because inflation is a continuous rise in the price of products and services. Low inflation's impact on interest rates. Interest rates are lower when there's low inflation. Borrowing will be more affordable when inflation and interest rates decline. As a result, borrowing will increase, and so will the money supply, and people will have more money to spend on products and services. As a result, as long as the supply of goods and services is stable, there will be a growth in demand or inflation. The cost of products and services has increased across the board in an economy, which is what inflation means. The Consumer Price Index indicates that in July 2022, inflation in the United States was 8.5%. As a result, the cost of items rose by an average of 8.5% per year. While not all goods and services were equally impacted by inflation, the highest rises were in the food and energy sectors. The total rise in pricing was influenced by a number of factors. Energy prices rose as a result of the conflict in Ukraine, and problems with the supply chain raised the price of other goods like cars. In other words, high prices resulted from an imbalance between the supply and demand for products and services. This is where the Federal Reserve System steps in. Its major duty is to maintain low levels of unemployment and inflation in the United States, which it accomplishes through managing interest rates or the federal funds rate. The Fed raises the cost of borrowing money for individuals, businesses, and banks by raising the federal funds rate. Due to increased interest rates, you can see a higher annual percentage rate, APR, on your credit card or a higher annual percentage yield, APY, on your savings account. This implies that individuals who have revolving debt on their credit cards may pay higher interest rates on a monthly basis. Suppose you presently owe money on your credit cards. In that case, you might want to consider getting one that offers a 0% APR introductory period on new purchases or balance transfers to help you get by. For instance, the Wells Fargo Reflect Card, a good no annual fee option, offers a 0% introductory APR for 18 months, after which 15.99% to 27.99% variable APR. Starting from the date your account is open for purchases, as well as qualifying balance transfers made within the first 120 days, all of which are subject to the introductory APR. As long as you continue to make the required minimum payments on time during the introductory period, there's also the option to extend it for an additional 3 months. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. Also, don't forget to check the links in the video description. And while you're here, I'm sure you want to continue on the path of financial education. Click to watch the video appearing on your screen right now. I'll see you there. Take care and stay tuned.